Hello again, and welcome to another episode of the Uranium Market Minute. Today is Wednesday, December 8th, and this is episode number 47. My name is Justin Hune. I'm your host, the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you so much for joining. Really appreciate you all being here. Thank you so much for all the wonderful comments, all the support on Twitter. I really appreciate everything. If you've been enjoying these almost daily podcasts, we appreciate you subscribing to the channel. You hit the notification bell, you will be reminded whenever we publish a new episode, which is almost every day. And please like this video. It helps the algorithms get us out there and bring more investors into the uranium space, which is something that we all want, right? Before we get into it, nothing in this video is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own choices. Let's jump right into the daily scoreboard. Spot price of uranium today unchanged from yesterday at $44.75 a pound mid-market. Still pretty quiet out there in the spot market. We're seeing some slight ticks down, slight ticks up day over day. Nothing really happening there with the Sprott Physics Uranium Trust largely or entirely out of the spot market for a couple of weeks now. And we know that utilities are also kind of steering clear of the spot market, knowing how thin it is and not wanting to put any upward price pressure on the market, considering it affects their forward deliveries. The spot did rally nicely yesterday, though. They closed at a premium to NAV for the first time in the last 13 trading sessions, consecutive trading sessions. They closed at a 0.63% to NAV, just under that necessary 1% premium that they need before issuing shares into the open market. They did issue a little bit of shares. They didn't raise much, just over $100,000 yesterday, but they did not purchase any new pounds of uranium. Because they didn't spend any money yesterday, they still got just over 32 million in cash in their treasury. And again, the numbers since their ATM went live mid-August, they've acquired almost 23 million pounds of uranium, 22.8 to be precise. And they've raised 994.7 million in new capital. This is just over 3 months. And again, they have a full allocation, 3.5 billion, another 1.2 on top of their existing 1.3 for the ATM, with an additional billion on top of that for off-market capital raises. Turning to the ETFs, we're really surprised, honestly, to not see more redemptions in shares for the two ETFs. URA reporting only 180,000 in share redemptions. URNM reporting no change in outstanding shares. Very surprised to see that, considering the lag time that we usually have of anywhere from 1 to 3 days for these two ETFs to report change in outstanding shares, and the price action that we saw at the end of last week. So the redemptions yesterday gave rise to only 3.1 million in mandated selling, really nothing significant. And we saw some nice moves in the sector yesterday with a decent amount of follow through today. On the back of yesterday's strong sector bounce, we would expect to see some ETF inflows in another couple of days. So let's see how that reports in the next couple of days to see if yesterday they did issue some new shares into the market. I wouldn't be surprised, although the volumes weren't huge, but still, considering the moves in the market, it's highly likely they did. Let's go ahead and take a look at the charts. Starting off, as always, with URA. URA is the largest ETF in the uranium space. It's only 70% allocated to pure uranium plays, but it still has the most liquidity. Therefore, it has relevance in this market in terms of institutional capital flows. Looks like a pretty indecisive day today for uranium, for URA in particular. It's down about 0.5% on the day with about 10 minutes left of trading in the day. Looks pretty indecisive. Bears are not in control. Bulls are not in control. Looks like folks are just kind of on the sidelines waiting for the next major inflows to come into the space. Sprott Physics Uranium Trust, similar, up a little bit today with spot price flat. They very likely are close to that 1% premium to NAV, maybe even slightly above it. However, look at the volumes. The volumes are negligible into this trust today. Indicators, look at this long period of sideways chop in the indicators. This thing is ready to go at any moment, and I believe that is incoming soon. Generally speaking, most of these consolidation patterns do end up breaking out in the direction of the overall trend. And if you want to see the very basic technical indicator of an overall trend, you look at the 200-day moving average. This purple line here, it is moving up. Even the 50-day is turning back up. This is a bullish chart, and we expect this to break out to the upside when it does break out. Will that happen tomorrow? Will that happen next week? Will that happen next month? I don't know, but it will happen. And it's my opinion that it will break out to the upside. Of course, I could be wrong in this, but that's just what I'm seeing. We are seeing declining volume the last 3 trading days, while the last 3 trading days have been moving up. It's not really what I want to see for the next big breakout. So I wouldn't be surprised if this ticks back down a little bit. Maybe this wedge tightens a little bit here. Not too concerned about this. Overall, a nice looking chart. Again, technical analysis on a chart that tracks a commodity is a little bit of a fool's game here, considering that the price of the commodity really dictates where this chart goes, considering how closely to NAV they generally trade. However, this chart and the volume and the flows into this trust actually have been dictating the price of the spot. So in that case, it does have relevance. Taking a look at Cameco down a little, almost 1%, about 0.64% on the day, with about 10 minutes left in the day. Again, not a whole lot of direction here. Looks like it's just a little bit of profit taking from yesterday. Not much. The indicators look like they're turning up. In my opinion, we're close to a move in the opposite direction, again, in the direction of the overall trend, reversing this correction that we've had over the past few weeks. So the mailbag question today is not a specific question, although I've had a question very similar to this that I will keep anonymous from the person who asked it. And it kind of really goes back to a very simple principle of making money in the markets. But I think that the answer is a little bit more complex that I think a lot of traders and a lot of new investors don't really think about, and it has to do with taxes. And so the question essentially is, Justin, if these stocks are moving down, why not sell out of your positions and buy them back lower? And I know that sounds like a really simplistic question. And of course, the classic, how to make money in the stock market: buy low, sell high. And you're welcome. It's not that easy, really. But the point that I'm bringing up with this is that there's, at least in the United States, and I know this exists in many other countries, if you're in the Cayman Islands, if you are operating out of some tax-exempt retirement account, perhaps, then these principles don't necessarily apply. But for the most part, for most people in most countries, there are capital gains taxes that you have to pay on investment profits. And so in the United States specifically, you have short-term and long-term capital gains that are dictated by a 12-month time period from the point which you bought the asset that you sell at a profit. So if you buy a stock and sell it at a profit within 12 months, you pay a short-term capital gains tax. That in the United States, that tax rate is your personal income tax rate. So if you happen to be, let's say, in the upper tax bracket, then that's a close to 40% tax that you have to pay on those profits if you buy and sell within a 12-month period. The good thing about long-term capital gains is that they're roughly half of the percentage of short-term capital gains. So with all of that said, this is a major issue when it comes to swing trading positions. And this is one big reason why we do not swing trade positions. That's not to say that we don't change positions, that we don't sell partly, part of a stock to buy another stock, that we don't go to cash once in a while, or at least partial cash. A lot of times we will sell out of a company or trim holdings in a company if we feel that the fundamental story has changed in the company. That's not what I'm talking about here. I'm talking about trimming and not trimming gains. I'm talking about actually swing trading positions. So if you want to buy X position and hold it, and you're up pretty nicely on it, you want to sell out of it and buy it back lower, and you think that you've done a great thing and taken some profits off of the table, which technically you have to consider the taxes. So let's use an example here. Let's say you bought NextGen on the opening print of 2021 at $2.78, okay, the first trading day of the year. Because you were so clairvoyant, you sold it on the high print of $6.47 on November 8th of this year. That's a gain of $3.69 of every share you own. Awesome. Great trade. Now the bad news, the tax man. Because you held the shares for less than 12 months, that's a short-term capital gain. Combined with state taxes in many states in the US, many taxpayers will be creating a taxpayer liability of $1.48 per share. Worse yet, if you then bought it back, you'd be resetting the clock for another 12 months before the same holding would be eligible for long-term capital gains taxing. So basically, you're either way, whether you buy that position back, you're going to be writing a check to the IRS on April 15th of 2022 for the equivalent of $1.48 per share of those profits. Let's do the math. Assume you were able to sell that high print 647. You have to send $1.48 to the IRS. You'd buy NextGen back at $4.99 or better to end up ahead of the game for getting commissions. So you say, well, let's look, it's $4.67 here, right? Currently, today. Not that simple. If you did and you wanted to exit the trade before this date next year, 12 months from now, you would pay short-term capital gains again if you sell that at a profit. While the investor who never sold would only pay one long-term capital gains on their entire position. Okay. So the moral of the story here is once you factor in taxes, the math very much changes. And that's something that you have to keep in mind. And again, I'm not professing to understand the tax laws in every country. I definitely do not. And you really should do your own research and figure out what they are exactly. But this is one major reason why we don't suggest, nor do we ourselves, trade in or out of positions that we're long in, especially when we're long for fundamental reasons, for a bull market that we feel is going to last another number of years potentially. There's so much less headache, there's less taxes that you pay, and the math gets really complicated if you're swing trading positions. That long-term capital gains tax that you get eligible for after a 12-month hold really has a lot of benefit. Now, of course, if you sell at a profit in less than 12 months versus hanging on to a position that you end up not having a profit after 12 months, of course, you're better off paying 40% taxes on a profit than not having a profit at all. But for these types of positions that we're holding for fundamental reasons, we always like to get eligible for that long-term capital gains whenever possible, unless, of course, the fundamental story changes. Then the fundamentals, trump whatever those tax rates might be, or the short-term reasons for owning this position. Again, that is mainly a fundamental thing. If you are a technical trader, then you've got a whole different set of rules. If you're buying and selling based on the charts, then those are your rules and you should follow those rules. Technical trading, in my opinion, is great. I've done it for many years. I still do it in a separate account. I use very, very simple technical analysis, as you can tell from these videos. I don't get too complicated. I just use what works for me with moving averages and basic bullish candles, bearish candles, bullish and bearish chart patterns. And that's what I like to look at in volume. High volume breakouts of a bullish chart pattern. Those are my classic technical trades. But of course, you have to factor in how are you going to get out and why are you going to get out? And so when I technical trade, I trade basically where I determine a stop loss that has something to do with the pattern that I'm looking at. If I go long, what will that chart look like and where will it have to close below to invalidate my technical thesis for being long that stock? Whatever that level is and whatever that loss is, that dictates the size of my position. So if I trade technically and I get bumped out on a stop loss, which happens a lot, by the way, usually your winners vastly outperform your losers if you can be, religious and not emotional about your exits in a technical trade, then a minority of those trades are winners, but they vastly outperform and outpace the amount of loss on the losers. So that's just kind of a technical trading rant. But just, those taxes you have to keep in mind for these sort of things, which is why we generally are buyers when the markets are weak, when the uranium market is weak, and we hold through these times of euphoric, profit generation in these intra-cycle, smaller cycles. It's not to say that we won't in the future take some profits, but it won't be for the reason of trying to buy the same position back lower. It's not a game we play. If you want to do it, you do you, go for it. Totally fine by me. But, if you're coming and asking me, Justin, why aren't you selling out? Why didn't you sell mid-November and buy back last week? These are exactly the reasons. Some of these positions we took this year. We also don't, in case we want to exit these positions in a time frame that's less than 12 months from now, which I don't plan on it, but I can't predict the future. We don't want to reset that capital gains clock. So if we were to sell even at a long-term capital gains 3 or 4 weeks ago, buy them back last week, and then again sell them in less than 12 months, then we're paying taxes twice. We're paying long-term capital gains once, short-term capital gains once. It's just not a game I want to play. And so I just wanted to mention that all to you all. And that's why, to our members, why we recommend not only buying in tranches, buying, nibbling on these positions as you enter them. When things get really weak, when they drop down to the 200-day, like they did over the past couple of weeks, especially last week, that's the time to get more aggressive on the buy side. And when it comes time for the next strong move up, You want to trim your positions, by all means, go for it. You want to sell out your positions and buy back lower, go for it. If you think that you can time the markets well enough to do that well, and you don't really care about the tax implications, or for whatever reason, you have a retirement account that's tax exempt, you live in a country where this is irrelevant, then go for it. Go ahead and take that chance. For me, it's just not something we're interested in. So thank you for listening. I hope that this has been beneficial and helpful for some of you all who have been asking these types of questions. Yeah, if you're interested in getting a sample newsletter from us, we just put out a 35-page newsletter last week for the month of December. And we went thoroughly into all of our focus list positions and all of the current technical and fundamental aspects of this market that we think are extremely relevant for investors. And we've been recommending to our investors to our members, excuse me, to get more aggressive when the markets get weak. And essentially everything was a buy last week. So hopefully some of you heeded those calls if you are a member of Uranium Insider Pro. If you're not and you want a sample newsletter, click the link in the description for this video. Thank you so much. I will see you guys tomorrow. Have a great rest of your day. Cheers.